Okay, welcome back to EverGuide Financial's Investor Education Series. Today we're going to start talking about ratios. Now that you understand the income statement, the balance sheet, and cash flow statement, it's time to look at ratios. Ratios are important because they give you more depth into what is happening at the company. Plus, it combines different aspects of the income statement, the balance sheet, and the cash flow to really understand the strengths and weaknesses of a company. So there's four main categories of ratios. The first is profitability. How much money, it's basically how much money the business is making. Second one is liquidity, which demonstrates a company's ability to pay its obligations. Third one is leverage, how much the company depends on borrowing. And then the last one is operating efficiency. So how good is management actually at running the business? So we'll start with profitability. Here's just a few different ratios that you want to look at. So the first one is gross profit margin, which is basically just gross profits divided by net sales. And this shows how attractive a business is. And you could have a business with an 80% gross profit margin. You can have one with 50% gross profit margin. Obviously, the ones that have the higher profit margin are more attractive. But it also means that there could be more threat of new people coming in, because somebody else is making money and they're making a lot of money. That means that always invites competition. So next is return on assets, which is just net income divided by total assets. And this really shows how effective the company is at deploying assets. Again, all things being equal, higher return on assets means that you're able to generate more return or more income from fewer assets. So that's a good thing. And then the last one is net profit margin. That's just net income divided by net sales. And this just looks at, after all expenses and everything's taken care of, how much money is left at the end of the day. How much money is the company making? So next we'll talk about liquidity. And this is important because it looks at how you're able to pay your obligations. So the first one is the current ratio. This is just current assets divided by current liabilities, again, showing the ability to pay near-term obligations. Next one is quick ratio. And this is basically the same as the current ratio, except you're looking at cash, receivables, and securities. So it's taking a look at your most liquid assets. It's called a quick ratio because how quickly can you pay those current liabilities? And then the last one is cost of sales. And this is your cost of sales divided by accounts payable. Again, this is just showing how quickly you can pay your short-term obligations for any of the vendors that you have. Next, we'll look at leverage. And this is really going to look at how much debt. These all look at different ways on how much debt you have on your balance sheet. So the first one is long-term debt to equity. This shows the mix of how a firm is capitalized. Some firms can be 100% equity. Some firms can be, have a lot of debt, and that will really depend. So it's important to compare this to other companies in the industry. There's no perfect amount of leverage to have, but again, it just shows you the risk that's there. The next one is actually interest coverage. And this one's important because it shows basically you're taking your EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So it's a simple measure of cash flow to your total interest expense. And here what you're looking at is how comfortably can your company pay the interest charges that happen every month. If you can't, or it gets very, very difficult to it, that's when you run into problems and could potentially face the bankruptcy. And then the last one is long-term debt to assets. And then this just, again, shows how much the company relies on debt to fund its assets. Some industries require a lot of debt and require a lot of assets, and other industries don't. So again, it's very important to look at how that compares across the industry. The next thing is operating efficiency. And these are just a few of these, but this is probably where you're going to want to spend the most time. So the first one is inventory turnover. That's just the number of days in the period. So whether it's a quarter, whether it's a year, you just take the number of days. You divide that by the 12-month cost of goods sold over average inventory. And this shows, again, over the course of a cycle, how much a company's inventory is sold and replaced. The next one, accounts receivable turnover. This is showing how much a company collects. So, how much credit that's being given out for the accounts receivable, how much you're collecting over that time period. The next one is accounts payable, same thing. So one of them is accounts receivable, so how much you're collecting. Next one is accounts payable, how much you're paying your vendors. And the last part of it, so when you combine all these together, is the cash conversion cycle, which is your inventory turnover days plus your accounts receivable turnover days minus your accounts payable turnover days. And that's really how many days it takes to convert to cash. And so this is important because it shows, it really gives an idea of the overall cycle of your business and the sales cycle. So, if it takes 6 months for you to convert any sale to cash, and that's not a very attractive business. Versus if it takes a couple of days to convert any sale to actual cash, that's actually very, very attractive. And so again, it looks at the attractiveness of the company, but also compared to how it looks against the industry. So those are just a few real quick. So what's important to know? And again, I talked about this already, but ratios should be close to what others in the industry are doing. Meaning most businesses in the same industry are going to have similar ratios. If there is a gigantic outlier, so for instance, if you're looking at a company and they have a profit margin of 80% and they have a cash conversion cycle of 5 days, and everybody else in the industry is at 50% and their cash conversion cycle is 60 days, that is a huge, huge difference. And sometimes you want to look into that a little bit more. How believable are those numbers? Are they cooking the books? Is something else going on? Doesn't mean they can't be better or worse than anybody else, but you just don't want to have a huge discrepancy between them. Next, the trend in ratios is a great indicator of how well or poorly a company is doing. If ratios are getting better, that's obviously a good thing. If they're getting worse, you want to know why. Next, consistently poor metrics can be a problem. So things happen from time to time, 2020 being a good example. If you have a period where, let's just say, your interest expense is too high, if it's only one period, it's not necessarily a problem. But if it's consistent, then there may be something else going on where they would need additional financing, either through a bond or equity sale. They might need somebody else to have a takeover, or they could eventually file for bankruptcy. So it's good to look at that consistency. And last, ratios should be used in isolation and combined with what you did already on the income statement, balance sheet, and cash flow, and other things that we're going to talk about in the future. It shouldn't be used on a standalone basis. So thanks again. For more videos, please subscribe in the bottom right-hand corner.